Hi, this is Jose Martin, your friendly neighborhood certified financial planner professional and the president of LifeCraft Wealth Management. As you might know, at the conclusion of each calendar quarter, I run a deep analysis of the performance of our model portfolios along with due diligence of the underlying managers and strategists we use with the goal to provide the best potential outcomes to our clients. Until now, I've completed this task as a behind-the-scenes exercise, but I realize that as clients, you have the right to understand how your portfolio is constructed and how your funds are invested. To that end, I thought a good start would be a quarterly video showing you how we make the sausage, so to speak. First, a quick note on our philosophy as it relates to portfolio construction. Unlike traditional portfolios that typically rely on two asset sleeves for construction, stocks for growth, and fixed income or bonds for stability, we use three sleeves: a growth sleeve, a low volatility sleeve, and a flexible tactical sleeve. For our flexible sleeve, we deploy managers and strategies that have the discretion to be fully invested in the market when their analysis indicates favorable opportunities, and conversely, can move to cash positions when the outlook is not favorable. The idea behind this philosophy is we want to do a little bit better when things are going well in growth markets and be a little bit more cautious when things are expected to worsen. So for example, a traditional moderate or balanced portfolio might look like this: 60% stocks for growth and 40% bonds for stability. Our version of a moderate portfolio would be built this way: 30% growth, 40% low volatility, and 30% flexible. That is, unlike the traditional portfolio construction I mentioned earlier, which stays static in its construction regardless of how markets and economies are performing, we like to be able to speed up or slow down depending on prevailing conditions. Objectively, we measure those outcomes by analyzing metrics that go beyond simple performance and look at maximum drawdowns, risk and volatility measures like standard deviation and beta, as well as upside and downside capture ratios, which tell us how much of the upside a portfolio captures when the stock market, as measured by an index like the S&P 500, is going up, versus how much it captures of that same index when it's going down. If, over time, we can get a higher upside capture and a lower downside capture, then that portfolio is performing as intended and desired. So, what were our results from this first quarter and what adjustments, if any, will we be making? Well, as I'd mentioned in a recent video commentary, the first quarter of this year saw the largest quarterly decline in the market since 2022. And, analyzing our portfolios against their respective benchmarks, we had marginal underperformance in this particular quarter as the rapid volatility and declines occurred at times when the flexible sleeves were mostly fully invested. However, we don't believe that a bad month, quarter, or year discredits our philosophy, and when zooming out, we still believe that in the long run, our methodology is sound. We could rest on our laurels here and call it a day, but we don't, because we subscribe to the Kaizen philosophy of continuous improvement. That is why each and every quarter I take a deep dive to see if we can do better. As a result of our analysis and due diligence, following are the adjustments we've made to each of the respective sleeves. For the growth sleeve, our allocation had been as follows: 50% allocated to Alpha V growth strategy, which typically holds about 20 individual stocks, and 50% to Pacer cash cow strategies, which are owned as exchange-traded funds. Following the analysis, 50% will be retained in the Alpha V growth strategy. Pacer cash cow strategies will be retained but reduced to 25% total exposure, and new to the lineup will be AQR, and one of their equity strategies is held in a mutual fund. This strategy provides exposure to additional international securities while hedging against companies that are expected to underperform. It will also have a 25% allocation in the growth sleeve. Securities of interest that have been traded by Alpha V within the growth sleeve at the start of the quarter were the addition of Monster Beverage, Boston Scientific, and ADP, while eliminating our positions in Costco, Paychex, and Tesla. Pacer ETFs added Ford Motor Company, Expedia Group, and Uber Technologies, while selling Cencora and SkyWest, among others. In our low volatility sleeve, we are retaining the following four managers: Spectrum Low Volatility, Regan Capital, Alpha Architect 1 to 3 month treasuries, and North Square Preferred and Income Securities. Within our low volatility sleeve, we also have a designation to liquid alternatives, but we're removing Catalyst Funds, Systematic Alpha, and Milburn hedge strategies, and instead we'll be replacing them with AQR diversifying strategies, which will hold 10% weight across all of our models. Lastly, in our flexible sleeve, we had been invested as follows in our tax-qualified accounts, such as IRAs. 25% to Potomac Tactical Strategies, 25% to Pacer Trendsetter ETFs, 25% to Scarecrow Trading Strategies, and 25% to the Alpha V Top 5 Risk Managed Strategy. Following the rebalance, our flexible sleeve will now look like this: 50% Potomac Tactical Strategies, 25% Pacer Trendsetter ETFs, and 25% Scarecrow Trading Strategies. You'll notice we've eliminated Alpha V's Risk Managed Strategy from our flexible sleeve while retaining their growth strategy as the largest contributor in our growth sleeve. Why? Because when it comes to building our portfolios and managing your money, we are completely agnostic as to which managers and strategies we work with. We have no loyalties or commitments other than those which we owe to you, our client. So, putting it all together, here's what our moderate allocation looks like after the rebalance. I hope this helps you gain a sense as to the manner we are looking after your hard-earned investments, the rationale behind our portfolio construction philosophy, and the adjustments we make along the way. We'll publish another one of these following our next quarterly review. Till then, we thank you for your continued support, and we wish you joy, love, health, and prosperity.